Welcome to This Week on Wall Street, your essential briefing on what matters most in markets. I'm Matt Weinschenk, the Director of Research here at Stansberry Research, and this week we've simply got to talk about the Fed. Stick around, and by the end of this video, you'll understand how these decisions happening in Washington have a huge impact on your life. Now, to many investors, anything involving the Fed sounds like a snooze. Even the name, the Federal Reserve, feels like it was made to put you to sleep. Most countries name their central bank something like the Bank of England or the Bank of Japan, which sounds much more important and interesting. But here's the thing. The Fed matters big time. Whether you invest or not, right now we are at a fork in the road. Either tariffs ease up and the economy starts to roar, or the tariffs inflict more pain and the Fed steps in with rate cuts to soften the blow. In a very real sense, the Fed and the White House are in an economic policy battle. And the truth? Your paycheck, your job, your savings, they're all influenced by a system that you have zero control over. When recessions hit, they can change the lifetime earnings of people even for decades afterwards. Young folks who have the bad luck to join the workforce during a recession have lower earnings well into their 40s. They even have a lower life expectancy. And when it comes time to buy a house, well, your mortgage costs depend on where the Fed has set interest rates. You might have to settle for a smaller home simply because you picked the wrong time to buy. And we've all suffered through inflation through the last few years, which depends on monetary policy. Life can get expensive quickly, whether you like it or not. Or perhaps your career prospects changed as manufacturing moved overseas. Or maybe you have a small business and are struggling to adjust to the new tariffs. I'd like to say that all you need to do is keep your head down and work hard, but all this stuff matters to your livelihood and your wealth. It feels unfair, but ignoring it doesn't help. So this week, big moves are happening both on Wall Street and in Washington, and they matter. So let's break down the basics of what the Fed does and what they decided this week. So the Fed has two main jobs. It's called its dual mandate. Job one is keep people employed, and job two is keep prices stable. In other words, aim for low employment and controlled inflation. And how do they try to do that? They do that with interest rates. If the economy is struggling and jobs are being lost, the Fed can lower rates. That pumps more money into the system. It encourages borrowing, spending, investing, and hiring. But that borrowing and spending can lead to inflation. So if inflation gets too high, the Fed can raise interest rates to cool things down. So the trick is balancing both goals at once. Now, today, everybody wants to know the state of the economy and whether we are headed into a recession. Now, right now, at this very moment, things look good. Unemployment's at 4.2%. Inflation's at 2.3% based on the measure that the Fed looks at. And those are good numbers. Most of the worry about a recession comes from what we call soft data. That's things like surveys on consumer mood and company expectations. So when you ask consumers or businesses how they feel today, they're very worried. The hard data, the actual spending and production numbers, still looks healthy. But two warnings. That hard data can move more slowly than the soft data, and the tariffs have made the data a little bit harder to understand. For instance, individuals and companies have been buying up goods to get ahead of the tariffs. That's skewing the numbers. You can see that in the trade deficit. The trade deficit is how much we import versus how much we export. And Trump's tariff plan is supposed to shrink the trade deficit, but the March numbers show it's only getting bigger because people are trying to pull things into the U.S. Pharmaceutical companies, for example, are loading up on medicine that they've manufactured overseas so that they have it in stock before prices jump. And gold imports are still rising like we talked about last month. So all that looks like spending, but is it really a sign of a strong economy? Now, over the decades, the Fed has learned not to make big moves based on forecasts. They wait for real proof before cutting or raising rates. And this week, they chose to do nothing. Rates stay the same. But even when the Fed doesn't act, their words matter. Every tiny change in the Fed statement is like a secret code, and the Fed carefully crafts these statements, and then investors comb through them word by word to search for clues as to what the Fed may do next. So one very big thing stood out. It's an alarming line added by the Fed. They mentioned a new worry, saying specifically that the risks of higher unemployment and higher inflation have risen. So that right there is the Fed warning us of the dreaded stagflation, something I told readers about last month. And listen, tariff-driven inflation isn't something rate hikes can fix. Rate hikes lower inflation when it's caused by too much money in the system, but tariffs just make things more expensive. Also, at the press conference following the statement, Fed Chair Jerome Powell shared more. He said surveys show people are worried about tariffs, but the actual numbers haven't shown big effects yet. And he says that employment is broadly in balance and that underlying inflation picture is good. So the Fed, with the best data and the best economists, agree that if there's any trouble in the economy, it's not in the data yet. What the Fed is basically saying is, we don't know yet. Powell says he wants to wait for greater clarity before the Fed makes any moves. Now, if you look at the futures market, they still expect 3 rate cuts this year, starting with one in July, but Powell doesn't sound like someone ready to cut rates 3 times. And here's a secret for you. The Fed often just follows the 2-year bond yield with a bit of a lag. So that indicator doesn't really support 3 rate cuts either. So all this tells us that if markets are betting on big cuts, stocks might still be priced too high. But for now, we all wait. Whether we hit a recession and watch those around us lose jobs and wealth, we just don't know yet. And as for when the Fed steps in to give the economy a boost, I don't think the Fed is being coy or secretive. They just don't know yet either. We just have to watch the data because in the world we're in today, whether you're an investor or just trying to understand the market and the opportunities ahead of you, the data on the economy really matters. And we'll keep you up to date on all these developments at Stansberry Research. We produce tons of free, high-quality research on macroeconomic trends and the Fed's moves, so you should go sign up for free at stansberrydigest.com right now. And of course, hit like and subscribe here on YouTube so you never miss our market insights. That's all for today. I'll be back next week.